Welcome to today's Explainer, where we're diving into a massive name in the global energy market that's sitting at a pretty incredible crossroads right now, Shell PLC. Think about this for a second. Shell is deploying over $9 billion in share buybacks this year alone. To put that kind of cash into perspective, that's the equivalent of buying up an entire mid-sized energy company just this year. They've also just won a huge monumental court case, and yet, as of August 2026, the market is pricing this giant at a dramatic 10% discount compared to its European peers. So what exactly is going on with that massive disconnect?
Well, that's the core mystery we're unraveling today. Is this a brilliant contrarian buying opportunity, or is the market actually correctly sniffing out a structural decline? Shell is a company that literally dropped Royal Dutch from its name to signal a complete transformation of its identity, making it a perfectly polarizing case study. Are we looking at a severely undervalued powerhouse, or just a classic dying value trap?
Here's our roadmap for today. First, the mystery discount. 2, fortress fundamentals. 3, catalysts, LNG and courts. 4, the 3 structural risks. And finally, actionable triggers and our verdict.
Section 1. The mystery discount. Analyzing the gap.
Now, what's really interesting about this slide is the sheer scale of the headline discount when we pull the Bloomberg terminal data from August 20th, 2026. Just look at that trailing PE ratio. Shell is sitting at just 9.2 times earnings, while the sector average for European integrated majors is 10.8. That's a solid 15% discount right out of the gate. And if we look at enterprise value to EBITDA, it's the exact same story, 5.4 times versus a 6.1 sector average. Simply put, on a pure multiple basis, Shell is noticeably cheaper than peers like BP and Total Energies.
Moving on to Section 2. Fortress fundamentals, cash, and yield.
But look, we all know cheapness alone is absolutely not an investment thesis, right? I mean, a stock can be cheap simply because it belongs in the bargain bin. We have to look at what Shell is actually doing with all that massive cash flow. And that brings us to this incredibly important 7.3% figure. That is Shell's total shareholder yield. They offer a 4.8% forward dividend yield, and it's covered 2.2 times by free cash flow. What that means is they aren't borrowing money to pay you, it's all surplus cash. Then you add in their legally bound commitment to a $4.5 billion share buyback program in the back half of 2026, which brings the year's total to that $9 billion mark. When you combine the dividend and the share count reduction from the buybacks, boom, you hit 7.3%. Contrast that with Chevron at 6.1% or Exxon at 5.8%, and you can see Shell is returning a frankly massive amount of capital to its shareholders.
And crucially, they have the foundation to actually support it. Take a look at this balance sheet metric. Net debt to EBITDA is sitting at a really healthy 0.9 times. In just the first half of 2026 alone, Shell generated $17.2 billion in operating cash flow. After all their spending, that surplus is very, very real. This gives them what you'd call a fortress balance sheet in what is inherently a super cyclical industry. The big takeaway here? Shell literally has the firepower to weather a $60 a barrel oil price environment without even thinking about touching that dividend.
Section 3. Catalysts, LNG, and courts.
Okay, let's dive into this next part, because a company returning cash while its core business shrinks is basically the textbook definition of a value trap. We absolutely have to look at growth and momentum. In June 2026, Shell inked a $6.2 billion cash acquisition of Naturgy's global LNG portfolio. This expands their position as the world's largest LNG trader by roughly 15%. Volume is projected to grow 20 to 25% by 2028. But the really fascinating part is what CEO Wael Sawan highlighted. 85% of that is already contractually hedged at $12 to $14 per MMBTU floor prices. In an industry that is totally defined by wild crude oil price swings, Shell has managed to lock in a massive base level of earnings visibility that's almost completely insulated from Brent crude volatility.
Then there's the legal catalyst, which is, frankly, monumental. On July 29, 2026, the UK High Court overturned a 2021 Dutch court order. That original order had mandated Shell to cut absolute carbon emissions by 45% by 2030. Overturning it removed a massive regulatory hurdle. Under the old reality, Shell was effectively forced to divert an estimated $5 to $7 billion every single year into lower return renewable projects just to satisfy that legal mandate. The new reality? The court ruled Shell's transition plan, which targets a 20% reduction in carbon intensity, is legally sufficient. This frees Shell up to maintain its $22 to $25 billion annual capex budget squarely on high-return LNG and deep-water oil projects. It effectively extends the economic life of its core assets by at least a decade.
Section 4. The 3 structural risks. The bear case. Now, as smart investors, we don't just look at the rosy picture, right? We need to examine the antithesis, those verified, measurable risks that we absolutely must acknowledge before deploying any capital. There are 3 heavy anchors dragging on this stock right now. First up, ESG sentiment rot. According to a Morgan Stanley institutional note, the EU's tightened SFDR regulations, their core sustainability framework, mean European passive funds are systematically rotating out of legacy oil names. This isn't even about company performance. It's about rigid multi-billion-dollar institutional mandates forcing selling pressure, which, explains a good chunk of that discount to peers like BP. Second, we have a total crash in refining margins. And third, integration risk. Shell paid 11.5 times forward EBITDA for those Naturgy assets, which is a pretty steep premium over their own 5.4 times multiple. If projects in Texas or Mozambique run into cost overruns, the return on that massive investment is going to plummet.
Let's actually focus deeply on that second risk for a second, because the numbers here are pretty stark. Look at the crash in refining margins. Back in 2023, crack spreads, which dictate refining profitability, were sitting nice and high at $28 a barrel. But as of August 2026, because of massive new mega refineries coming online in China and the Middle East, that spread has been completely crushed down to just $12 a barrel. Now, keep in mind, downstream refining makes up roughly 18% of Shell's gross profit. If these margins stay depressed, Shell could actually miss their 2026 free cash flow consensus by a staggering $3 to $4 billion. That is a massive hit.
Section 5. Actionable triggers and verdict. The synthesis.
So we have incredibly strong cash flows and growth catalysts going head-to-head with severe structural risks and major macro headwinds. Where exactly does the market stand on this right now? Well, Wall Street is completely fractured. Just look at the verified analyst consensus. 9 buys, 11 holds, and 3 sells. Price targets are just all over the place, ranging all the way from Bernstein's pessimistic 2,450 pence sterling to Goldman Sachs's highly optimistic 3,100 pence sterling. The market literally cannot make up its mind. But for an informed observer, that kind of division is exactly what creates a prime opportunity for those who actually do their homework.
Let's move to the timeline and see how this builds into something actionable. Over the next 90 days, there's a ticking clock of exact triggers that should act as your compass here. September 15th, that's the EU antitrust decision on the Naturgy deal. If it gets blocked, expect a quick 3 to 5% drop in the stock. Then, October 1st, Capital Markets Day in New York. You're going to want to watch the capex floor really closely. If management raises it above $22 billion, analysts are calling that a clear sell signal. But if they hold the line and confirm strong free cash flow, it's a buy. And finally, October 28th, the Q3 trading update. We want to see LNG trading optimization stay above $1.2 billion. If it doesn't, we might honestly see a sell-off across the entire European energy sector.
Which brings us to our final verdict, and the ultimate question you have to ask yourself. On one hand, Shell is a fortress of high-yield, high-cash returns cyclical value, freshly liberated by the courts to maximize its core assets with a massive LNG growth kicker. On the exact opposite hand, it faces undeniable headwinds from crushing refining margins and systemic, legally mandated institutional selling pressures. So, is this our ultimate contrarian value play? Or is the ESG reality and multiple compression just too heavy a burden for your portfolio to bear? That is the fascinating puzzle of Shell PLC today. I definitely encourage you to dig into those October filings when they drop. Thank you so much for joining me on this explainer, and as always, keep learning.